This weekly news flash is sponsored by American Retirement Systems, providing competitive solutions for agents and advisors. For more information, please visit AmericanRetirementSystems.com. Be sure to join us for ProWeb Chat on Twitter every Tuesday at 3 p.m. Eastern Standard Time. Simply search for hashtag ProWebChat and join the discussion. When many of healthcare reform's provisions take effect in 2014, as many as 3 in 10 employers will stop offering health coverage, according to a McKinsey quarterly survey. Under the law, just 7% of workers will be switched to subsidized exchange programs. However, 30% of companies say they will definitely or probably stop offering health coverage to their employees, according to the survey. Furthermore, employers who are more knowledgeable of the healthcare reform law are even more likely to stop offering coverage. 50% to 60% in this group say they expected to no longer offer employer-sponsored coverage after 2014. At least 30% of employers will consider dropping coverage for their workers even if they compensate their employees for the change through other benefits and salary increases. Surprisingly, 85% of employees say they will stay at their jobs if their employers stop offering health coverage, but 60% expect increased compensation. Insurance company assets managed by third-party U.S. investment firms rose to a record $1.75 trillion at the end of last year, according to an annual survey by Insurance Asset Manager. Outsourced insurer assets were at $1.1 trillion in 2008, but have increased significantly in the wake of the financial crisis. In 2010, such assets rose 13% from 2009's level of $1.55 trillion. BlackRock led the way in 2010 with $300 billion in total insurer assets under management. Both BlackRock and Deutsche Insurance Asset Management topped $200 billion for insurer general account assets, at $205 billion and $203 billion respectively. The medical loss ratio rules imposed on insurers under the healthcare reform law will worsen the cost and quality of healthcare, according to insurance agents. The MLR rules require insurers to spend at least 80% of premiums on medical care, leaving just 20% for profit and administrative costs. Agents and brokers are concerned if their commissions aren't exempted from the rule, then insurers will cut or eliminate commissions altogether. The MLR requirements are putting agents and brokers in a desperate economic situation, according to Janet Trautwein, Chief Executive of the National Association for Health Underwriters. Trautwein testified last week before the House Energy and Commerce Subcommittee on the issue. Trautwein told committee members that agent commissions should not be considered administrative expenses because they are mostly self-employed and hired by consumers. Large financial institutions and wirehouses are bracing for the departure of a large number of brokers and advisors during the next 2 years, according to a new study by AIT. Many leading financial institutions that spent heavily in recent years to attract top advisors and brokers could soon experience the departure of many top employees due to changes in economic conditions, according to the study. Firms attracted top producers through signing bonuses and 3- or 4-year retention packages featuring forgivable loans. As the retention periods run out, a growing number of advisors will look elsewhere, tempted by high signing bonuses at other institutions. Improving economic conditions will also encourage advisors and brokers to break away. Of respondents seriously considering leaving a wirehouse broker-dealer, 34% list their top destination as another wirehouse. 22% plan to go independent, and 19% intend to join an insurance company broker-dealer firm. Among non-wirehouse broker-dealers planning to defect, 32% plan to go independent, while 28% plan to join a private bank or family office. 20% intend to join a wirehouse. For more on the industry, visit producersweb.com.